For the next hour, you'll be leaving the show me state and entering the show me the money state. So stop what you're doing, grab a pen, and get ready to learn. Jake Floyd of Floyd Financial Group will be your guide for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Jake Floyd and Jeff Shade.
Good morning. Thanks so much. Welcome to Show Me the Money, the show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current events, some retirement mistakes you want to avoid. We'll then discuss essentials in a successful retirement plan. And then finally, we'll compare Floyd Financial Group, an independent advisor, with some of the big box advisors. My name's Jeff Shade, and as always, I'm just here to ask the questions. But of course, the words of wisdom and solid advice, they come from Jake Floyd of Floyd Financial Group. Hey, Jake, good morning. How you doing today?
I'm doing great, Jeff. How about you?
I'm doing fantastic, thank you. Easter's behind us. I guess the next big holiday is going to be Memorial Day, and then we're going to be halfway through the year already. Boy, time flies when you're having fun. But anyway, a lot to talk about on today's radio program, Jake. There's a lot going on in the world out there. Some people are sort of fear mongers, and that's what I thought of when I saw this first article here that said Ray Dalio fears something worse than a recession if we keep going the way we're going right now with these tariffs in this trade war. But Ray Dalio kind of makes money off this sort of stuff from what you're telling me.
Right. So Ray Dalio is a hedge fund manager, a very, very large one. In fact, at one point it was the largest on earth. One of the things with a hedge fund manager, though, is they make money going both directions, meaning if the market's up, they have about usually half their money that's set to go along with the market where they have investments, and then they have about half the money that they have under management where it goes against the market. And so it's more about picking the correct stocks and having volatility than it is about their direction agnostic. So if the market's going down, they can make it. If the market's going up, they can make it. To a very large extent, guys like Ray Dalio thrive off of the volatility. And somebody as big as him who has tens of billions under management, those guys really benefit from this sort of market. And so he has no incentive to be calming to the market because he's making tons of money at times like this.
So it seems that you read these articles from Ray Dalio and other people just like him too, and he's painting this situation in which the U.S. and China, this would be a very tense situation with the trade wars, and it could escalate into something even more. But I guess this goes to show again, Jake, like we've talked about, there is no impartial news out there. Everybody seems to have an agenda these days.
Yeah, in the market, we call it talking your book. You know, if I have 30 stocks in my portfolio and somebody invites me on TV, what am I going to talk about? I'm going to start pumping all my stocks, right? I'm going to be like, hey, this is a great stock. You should get in here and you should get in there and yada, yada, yada. And so it's important when you watch, especially financial news, that there's nobody there that's actually neutral. Every single person that they have on the show has an agenda. And most of the time it's to, again, pump the investments that they have and try to get people on board with their line of thinking. That doesn't necessarily make it wrong. Just realize that they all have an agenda when they come on there as far as what they want to say and the way they want to direct the people in the audience. And so once you realize that it's not a, hey, these guys are here to make me feel better, or these guys are here to educate me. It's no, these guys are here to try to use me to their benefit. And once you realize that, you watch these programs in a whole different light.
And it's really unfortunate, Jake. I mean, if you want some unbiased information, if you want some reality as far as what the market is going and maybe some advice on what to do, you can't turn to the national media. So what should you do?
You know, that's a great question, Jeff. It's very difficult to come up with unbiased information unless you're creating it yourself, doing research and things like that. So having an advisor comes in handy because you've got somebody that's got their finger on this stuff, or should at least. You know, it's possible you may have an advisor that really doesn't pay attention to what's going on with markets and people's money and different investment types and that kind of thing. But hopefully if you have a financial advisor, he's paying attention to that stuff for you so that you don't have to try to dig it up all the time. But yeah, it's getting harder and harder to find unbiased information, whether it's financially related, politically related, or really almost any topic at this point.
Yeah, it seems that everyone has an agenda and you've got to separate facts from fiction and do your own due diligence. Talking with Jake Floyd here, Floyd Financial Group on Show Me the Money. And of course, the radio station is KSGF 104.1. We're here with you each and every Saturday morning. Let's continue now to another story, which is interesting. Trump ramps up attacks on Powell, demands that loser Fed Chair Powell lower those rates now. What do you think about this story?
Honestly, the very first thing that comes to mind when I read that is I saw the actual truth or tweet or post or whatever we want to call it, right? And what all the news articles left out, probably the funniest part of this, is the very first thing he called him was Mr. Too Late, Jerome Powell. And I thought that was way more of a headline than he's a loser. Mr. Too Late. That really struck me funny, especially given the T word, right? Transitory inflation that was all the buzz in late 2020, early 21, mid 21. And they're like, wow, maybe it's not so transitory. And I've noticed that some of these strategists are starting to bust out the T word again. They're saying, hey, this tariff stuff is now transitory inflation by nature. And I'm like, oh man, you got to be careful with that word. That's that word has some serious history behind it over the last few years. So I do think that Trump is kind of feeling out what would maybe happen if he tried to fire Powell. And I don't know. There's a lot of speculation on whether he can or can't fire Powell. There's a lot of places that say he can't. I don't know that that's true. I think it's a little bit like pardoning oneself as president. The Constitution and the laws don't really prevent that, but it's never really been tried before. While the president appoints the Fed chair, it's a little bit implied that he might have the power to fire him, but nobody's ever tried it, and they're supposed to be independent, so how dare you try to fire him? I don't really know how I feel about that. I don't really know whether that's legal.
Right.
But I think what Trump's trying to do is feel out what the response would be if he did try to fire him. And so he's kind of has this relentless series of attacks on Powell. Honestly, this is probably one place where I actually disagree with Trump, where I think that if he really wants Powell to lower interest rates, he's making it more difficult by railing against him all the time, because it seems like then if Powell does lower interest rates, it's going to really seem like he caved to political pressure. So he might actually want to lower interest rates at the next meeting or the one after. But if he does, it's going to look like he's acquiescing Trump's request, right? And so I think it's likely that if Trump would just stop messing with him, I think they're very close to cutting anyway. And as we get this month's CPI and PPI report, the inflation reports from this month, which we will get kind of early next month, I think those are going to show massive deflation. When I say massive comparatively to where we've been, right? Because the last report, we were down 0.1 on both of those, which is a very small amount of deflation. I think we're going to see a more moderate number, maybe 0.3, 0.4, which for 1 month is quite a bit. And I think when we start to see that, the Fed will start to take notice and will likely start cutting rates. So I don't know that Trump needs to have all this pressure, although it may also be for a victory lap later, where when he knows that Powell has to cut at some point, and he's going to be like, hey, look, I made him cut, and look at all the prosperity I brought, and all that kind of thing. So I don't know exactly what the end game is, but it does seem to me that Powell has to cut either way. So I don't know that that extra pressure is helping that situation right now, but we'll have to wait and see how it plays out.
Well, Jerome Powell's in a tough situation right now, but his term does end in about a year, May of next year. Let's talk about gold and Bitcoin. Boy, gold, it's over $3,400 an ounce right now. That's really incredible. Is this sustainable? How should we react to gold being $3,400 an ounce?
Yeah, so if you look at gold, if you look at a chart of gold, gold is 100% in a bubble right now. That's not a maybe it is, maybe it isn't statement. It's 100% in bubble territory. When you think of a bubble in the market, basically something that's gone too far too fast. When we think of the word bubble, we think of this kind of circular, squishy, spherical bubble, right? On a chart, a bubble looks like a big spike. It looks like something that you could hurt yourself on. Meaning when something goes parabolic or is in a bubble, it goes up faster than it goes to the side on the chart. And it kind of creates this really sharp point at the top. Now, the other side of the bubble is the same type of momentum, but down the other side. And so I'm not saying necessarily that gold is going to crash, but it has definitely gone way too far too fast, and it cannot continue on its current trajectory. So it's either going to have to take some time off, or we're going to have to see it correct and come down quite a bit, and then it can kind of take its next leg up. But it is going to have a little bit of period of, it's going to require more patience than it has to this point to stay invested in gold. Again, I don't really have an issue with gold. I get asked about it literally almost every meeting. Personally, I think that gold is a very difficult asset. Physical gold is a very difficult asset to use in retirement because it's illiquid and commissions are super high if you want to go buy and sell it. But if you're going to buy it and forget about it for 30 years, I don't really have an issue with gold. But personally, at this level, it's hard to get excited about it because it's so pumped up. It's had a huge run. If we do get a correction, I might be interested in it. But at this point, it's just really hard to want to chase it here.
Jay, can you talk to us about the relationship between Bitcoin and gold and other assets at this moment? Some people call Bitcoin digital gold, sort of gold with power.
Yeah, and I would agree with that assessment for the most part. I mean, gold does have a few inherent properties, the fact that it never tarnishes and it's a good conductor of electricity. But that would probably be worth, $50 or $100 an ounce, not $3,500 an ounce, right? So the majority of gold's value is there simply because we've decided as society that it's worth a lot. And it's really no different with Bitcoin, where what's the inherent value of Bitcoin is nothing. But we've decided because of its scarcity and because of its place in the world that it's worth $90,000 a coin or whatever it is at the moment. I think there's a lot of similarities between gold and Bitcoin, although people that support Bitcoin would majorly disagree with that, and people that are what we call gold bugs, meaning people who really love gold, would also disagree with that. But I think if you really evaluate the way they work, they're very similar asset classes. And because they're similar, they can detract from each other. And so during the majority of this gold run over the last 4 or 5 months, where gold has gone from, let's say, $2,700 an ounce to $3,500 an ounce, Bitcoin has fallen over that period. I think there's a little bit of give and take between gold and Bitcoin. But yeah, as far as a retirement asset, I'm not sure I like either one. Bitcoin's way too volatile. Gold's hard to eat, so you got to sell it every time you want to get money out. So again, no problem with those asset classes, just saying that they're not great retirement assets, which is, the primary thing that we talk about on this show.
Jake, let's talk about bank earnings. Bank earnings, I think, are really impressing everyone over the past couple of weeks. The question is this likely to continue given the economic tariff situation that we're in right now?
Banks really have a hard time when you start to have economy slow down. And that's what everybody's really concerned about with these tariffs, is that it will pour cold water on an otherwise well-functioning, hot-burning economy, right? And I think banks probably stand to lose the most from tariffs, not directly, but indirectly. And certainly if we are to get interest rates lower, that also puts pressure on banks. So all the banks pretty much beat all their estimates, but it was mainly because of trading. So all these big banks profit from excessive trading. They make commissions and things like that. And obviously it's been a very volatile couple of months here. And so these banks are doing very well in the short term. As we come down the other side of this, though, if we're in an environment that has less global trade, reshoring jobs over here, also with falling interest rates, that's going to be a pretty big headwind for banks. I'm not shocked that some of them guided a little bit lower and urged caution and things like that. As we get into the meat and potatoes of the tech earnings next week, I think that's really going to be where the rubber meets the road. If those earnings guide down significantly, the market could bleed some more. I don't think we're through this whole thing yet, so everybody just needs to kind of have patience out there, and we don't really know what's going to happen. We're in some pretty uncharted waters, so it's dangerous to jump out just like it's dangerous to jump in here. And so sometimes the best thing to do is wait for more information, and sometimes that's the hardest thing to do. But I do think that patience will pay off over the next few weeks here as we kind of get more information on the direction we're going and let some of these macro events start to play out as well as earnings. And we can see things a little more clearly in a couple of weeks from now.
We're talking with Jake Floyd, Floyd Financial Group. We've been talking about current events, of course, bank earnings, gold and Bitcoin, where inflation is right now, Jerome Powell. And again, if you've missed any part of this program, maybe you've just tuned into us and you'd like to hear the first part of it that you have missed, remember, we are a podcast. Go to wherever you get your podcast, search for Show Me the Money. You'll find this show and many of our past shows so you can stay on top of your journey towards a confident retirement. Also, if you'd like to get in and sit down and talk with Jake about current events and how they may be affecting your retirement portfolio, We're offering a Floyd Financial Group retirement review, no cost and no obligation. You can get it by calling 417-889-7233, 417-889-7233. You can call her right now if you want. Leave your name, telephone number. It'll take you about a minute to do that. Ashley will call you back during the week and set up a convenient time for you to talk to Jake. Again, it's 417-889-7233. No cost and no obligation and no judgment. We'll meet you where you are. Jake, time for a break. When we come back here on Show Me the Money, we'll be talking about some retirement mistakes that you may regret when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd. In this segment, we're going to be talking about mistakes that you'll regret in retirement.
And Jake, a lot of people make mistakes, and if you make them going into retirement's very important. You could certainly live to regret some of those mistakes. So we're going to try to cover some of the main ones here that hopefully we can shed a little light on for our listeners today. First one has to do with Social Security. You can really make a big mistake by taking Social Security at the wrong time, I think.
Yeah, so certainly taking Social Security too early if you're still working and having to pay it back. Social Security, if you take it before your full retirement age, you're only allowed to make in 2025, the number is like $23,900 a year without having to pay it back. If you make more than that and you're under your full retirement age and you file for Social Security, you have to pay back $1 for every $2 that you make. And so basically you can do that, but anything over $23,900 and you're working for half-time pay. Generally speaking, that would be a mistake because you're also not rolling up your Social Security anymore. Once you retire, however, it can make sense to go ahead and turn things on, even if you're still not full retirement age. There's a lot of factors that go into that, and we've done whole shows on Social Security, but I would agree with that, Jeff. I think turning it on at the wrong time or not turning it on soon enough can be a problem. I've seen people spend a lot of their money down trying to wait for Social Security to get bigger, and then they have no control because they've spent their money. Now all they have is the Social Security check, and you can't call J.G. Wentworth, you have an annuity and need cash now if it's just Social Security. So
yeah,
that was kind of a joke for those that remember the commercial. But
yeah,
ultimately, I prefer that my clients retain control for as long as possible. And a lot of times that involves filing for Social Security earlier rather than later so that we're not spending your money down waiting for Social Security to get bigger.
Jake, if someone's listening to the program today, they're in doubt that they have taken Social Security at the right time. As a matter of fact, based on our conversation, they think it is the wrong time, and they took it, let's say, a year ago. Can you suspend that, or is there a do-over, I guess I should say?
So there are circumstances where we can pay it back and refile later. That generally speaking is not going to make sense. There used to be a lot of rules that you could go back and you could file and suspend, file and restrict, file on your spouse, all these different things that you really can't do anymore. It is possible to unfile, if you will, but you're going to have to pay the money back, and that's generally not doable or maybe not advisable. But the best thing I would say is let's talk about your individual situation. If you're concerned about that, that's one of the biggest things that we talk about in here is Social Security and whether we should file it and what's my spouse going to get and all that kind of thing. So I can definitely help you walk through that process if that's something you want to talk about.
So Social Security, very important. Again, if you'd like to talk to Jake about Social Security, you can give us a call here, 417-889-7233. We'll run this Social Security optimization program for you, which will give you a lot of information as to when to take Social Security. Jake, do we often have to run that program, or is it pretty straightforward as to when to take Social Security?
It is a helpful tool to understand what we're doing. I will say that was probably a more helpful tool when there was a literal million ways to file for Social Security. I think it's less helpful now, but it's really more a factor of when are you going to retire? Because none of us know when we're going to die. So if you know when you're going to die, I can tell you exactly how to file for Social Security to maximize it, but nobody knows that answer. And so we have to make the best decisions we can with the knowledge that we have. But there are dozens and dozens of factors that go into when to file for Social Security. For some people, it's a relatively simple decision. For other people, it's less simple. Having a spouse or not having a spouse is probably one of the big changes, right? If you have a spouse, especially one that's been a homemaker, she will get some of your Social Security when you file, but she gets a percentage. And so you waiting increases her amount. And so there's a ton of different things to think about. So it's better if we can talk specifically about your situation when you come in for a consultation.
We're talking about retirement mistakes that you want to avoid with Jake Floyd at Floyd Financial Group. One of them is taking Social Security at the wrong time. Let's shift and talk about 401ks. Is borrowing from your 401k necessarily a bad thing in all circumstances, Jake?
So obviously we don't want to pull money out or borrow from a 401k if we don't absolutely have to, because this money's set aside for retirement. However, if you're in a pinch, taking a loan from a 401k is not the end of the world, and it can be a good way to borrow money in an environment like today where it's hard to borrow money elsewhere for lower interest. When you borrow from a 401k, you do have to pay it back over a certain time schedule. But when you pay the interest back, you're borrowing the money from yourself. So that money goes into your plan, back into your plan. So it's not like paying a third party a bunch of interest. So it can be a good tool, but again, obviously the best way to do it is just to not need it and leave that money alone for retirement. Because once you get used to tapping the piggy bank, you tend to want to tap it more. It's kind of like having a cookie over Easter Sunday. You have one cookie, and then you want to go back for a second cookie, and then a 24th cookie.
That's right.
And so it's better just to say no to the cookies altogether if you can do that. But the biggest thing with a 401k is we don't want to be actually withdrawing that money prior to 59 and a half and paying off a house or something like that. It's just very, very painful to do that. If you have a, let's say, $300,000 mortgage, and you want to pull money out to pay off that mortgage, which I hear people say they've done all the time, that's likely going to cost you $450,000 between taxes and penalties and everything. I mean, don't quote me on that, but that's the ballpark of what it would cost. That's a huge amount of money. There's definitely better ways to go about getting the house paid off, or at least just handling your income in general, so that we don't have to give such a huge amount of money to the government. Because I don't know about you guys, but I don't want to give the government any more money than I absolutely have to.
Yeah, I would agree with you completely. Again, talking with Jake Floyd of Floyd Financial Group, talking about retirement mistakes that you want to avoid at all costs. Next one has to do with long-term care and health care. You know, Jake, I've heard people say, well, I'm not going to worry about the long-term care until I need it, but that's not the time to do that. And I think most people will need some sort of long-term care plan. That'd be a big mistake, I would think, just neglecting that completely.
Yeah, when it comes to long-term care, there are a lot of factors to consider. You know, obviously nobody wants to think about needing that type of care, certainly not going to a nursing home. But the reality is 70% of us are going to need some type of long-term care before we're gone. And it can be one of the biggest expenses that you come across. And so I think that when we're thinking about long-term care, planning ahead is a better way to go about things. And there's different ways to pay for care. You know, there's insurance and there's annuity-based care and all kinds of different things to consider. There's trusts and things that you can use to also shelter assets and things like that in a totally legal manner. But yeah, simply not having a plan can be a way to really blow yourself up pretty good. So I do think that talking about that ahead of time and understanding potentially what asset you're going to liquidate first in a situation where you need to have long-term care will help bring home the reality of that for you.
Talking with Jake Floyd of Floyd Financial Group. Again, these are retirement mistakes that you could regret indefinitely. Neglecting estate planning, Jake, does everyone have an estate, or is estate planning just for the wealthy?
Yeah, so everybody is going to have some kind of an estate. Whether or not you need a trust is obviously a legal matter. However, most people will benefit from a trust. If you simply have a blended family, that's right there a need for a trust, because it's the only way to really spell out exactly how you want things to go and make sure certain people don't get disinherited. But yeah, everybody has an estate, and the estate is basically what you leave here when you're gone. And the estate plan is how that gets handled and who gets your stuff and all that kind of thing. So again, that's definitely something that's worth talking about and making sure we understand who your beneficiaries are. For a lot of people, it's just their kids, but for some people, it's charities. Some people don't have kids. Sometimes it's siblings and things. And maybe there's a brother-in-law that you don't like. You want to give money to your sister, but you don't want it to go to the brother. And so having a trust can keep all the bad things that you don't want to have happen from happening when you're no longer here.
And finally, I want to talk about this one, which is non-financial, Jake, the non-financial side of retirement. That is failing to understand what retirement's going to be like for you, or failing to have a plan, what you're going to be doing with your time in retirement.
Yeah, so I think a lot of people think that they're going to have a lot of free time in retirement, and some people do. But there's a lot of people that, I hear all the time. I said, I don't know how I ever had time to work now that I'm retired, because I have so much to do and I'm busier now than I was when I was working. And so I think a little bit of that depends on your circle, how big your circle is, how much family you have in the area, how many grandkids need babysitting and all that kind of thing. But it definitely understanding how much time you're going to have on your hands, and make sure you don't end up watching 12 hours a day of Netflix. People tend to go downhill if you sit on the couch all day. Not that there's anything wrong with the couch. But yeah, it's good to think about what you're going to do with your time and energy once you no longer have a career.
I think you're right about that, Jake, and also paying for what you're going to do in retirement. Most people, I think that they're going to be spending less in retirement, but it depends upon what you like to do. Retirement could very well be more expensive. What's your opinion on that one?
Yeah, I totally agree with it. Depends on what you want to do. So I have people that are big travelers, and when they retire, they just want to travel. Well, travel is not cheap. And so those people typically spend more in retirement than they do before they're retired. I would say, though, that my average client probably does spend a little bit less money in retirement, and partially because they're conservative and they're concerned about making sure they have enough money. But I think part of it too is, as you get older, you don't necessarily want to be go as much as you did when you were 25. And then you appreciate the time off and the peace and quiet and that kind of thing. So one of the things I say on this show a lot is, it kind of depends on whether you want to fish off the bank or whether you want to fish out of your $100,000 bass boat. Those two things are not the same, even though you're doing the same activity. But from a cost standpoint, they're definitely not the same. So understanding what's important to you is really our number one priority here, because once we understand that, we can build the plan around it to help make it happen.
And I think it's very important, too, to have some sort of a hobby. I wouldn't know what to do with myself, Jake. No, I'm still working. But when I get into retirement, I can assure you that I'm still going to be working on my 72 Cougar that I've been restoring for years and years. It's going to keep me busy. It's going to allow me to have some sort of purpose for my day. So I think it's critical to plan for your free time in retirement as thoroughly as you plan for your finances. Talking with Jake Floyd, Floyd Financial Group. Again, if you would like to get in and sit down with Jake, talk about your retirement journey, maybe what you're going to do in retirement and funding that. Again, we're offering a no cost, no obligation, no judgment Floyd Financial Group financial review to account for how you're going to spend your time in retirement. Our telephone number, 417-889-7233, 417-889-7233. Make that call this weekend. Ashley will call you back and set up a convenient time for you to talk with Jake and or Randy when he's in the office about your retirement journey. No cost, no obligation, no judgment. 417-889-7233. Also online, you can find out more about us at floydfinancialgroup.com. Time for a break, Jake. When we come back here on Show Me the Money, we'll be talking about some essentials every successful retirement portfolio should include, when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready to climb a mountain of financial know-how? Good, because it's time for more Show Me the Money with your financial Sherpa, Jake Floyd.
Welcome back to Show Me the Money. I'm Jake Floyd, and in this segment, we're going to talk about the things that are essential to your retirement portfolio instead of the things that we don't want in our portfolio, like we talked about in the last segment.
That's right, Jake. So let's talk about some of the pros here, some of the things that will ensure or maybe hedge the bet for you to have a successful retirement. The first one is going to be, I would say, a substantial income plan. Is that generally where you start with a retirement portfolio that will endure the test of time, Jake?
Well, ultimately, when you retire, what you're really trying to do is replace some or all or more even of your income, right? Because once you stop working, you don't have the income anymore. So yes, that is kind of the building block as we say, okay, we're going to have this much from Social Security. If you have a pension, we're going to have this much for the pension, and then that means we have a shortfall of X, so we got to figure out how to come up with X. And so that's where the retirement assets come in. But ultimately, retirement is a cash flow game, meaning how much we have coming in versus how much we have going out. If there's a way to inexpensively reduce outgo, generally speaking, that's better than trying to come up with more money simply because there's less taxation involved. But it's ultimately, how much do we need coming in? How much do we have going out? And yeah, that's probably the building block of every retirement plan.
And I think also with this retirement income source, it's having a diversified retirement income source. Of course, your dignity floor, what I call the dignity floor, is keeping food on the table and a roof over your head. And usually that's covered by Social Security and maybe a pension if you're lucky enough to have one. But what are some of the other alternative sources of income that we try to incorporate into a successful income retirement portfolio?
Yeah, you say that the dignity income, I think, used to be a guy could have a Dr. Pepper from time to time, but I don't know. That stuff's so expensive these days.
That's right.
I'm not sure that falls under the dignity anymore. So I think that having diversified income, if you can, is important. Not everybody has the luxury of having that, right? Because pensions are kind of a thing of the past, and we all have this thing called Social Security, but how long is it going to be there in its current form? Or is it going to get reduced? I don't personally think so, but I don't know that, right? I don't speak for all of Congress and the president. So it's important to have more than one leg to that stool. Now, one of those legs, if you will, is your retirement savings, right? We can turn on income, have it direct deposited to you just like your paycheck is now. If you have a pension, those things can also be another leg to the stool. But setting up income that you're not going to outlive is the goal of what we're trying to do when we're setting up a retirement plan and an income plan.
So Social Security, as you said, pension also if you have one. But what are some of the other sources? Would annuities be, for example, one of those sources that you commonly go to?
Yeah, so we can take money out of annuities. If we have cash value life insurance, we can take loans out of there to have tax advantaged income. There's all sorts of ways. There's a lot of people that have passive real estate income. I wouldn't advise becoming a landlord if you've never been one, but there's a lot of people that have been a landlord for a long time. And it's kind of old hat to them. Having that as another leg of their retirement income is not necessarily a bad thing. There's a lot of ways to do that. If you have different legs to that portfolio, it helps you be a little more resilient when times get tough.
So the first leg of this successful retirement portfolio is going to be not only having an income plan, but diversified income sources. Would dividend-paying stocks or ETFs be a part of this plan in every case, or is it just sometimes, or is it never?
So I think it really depends on your other legs and risk tolerance and that kind of thing. We do use some dividend-paying ETFs and some bond funds and things like that from time to time, and it depends on the situation. There's dividend-paying stocks too out there. We're probably going to come up on this one here in a minute, but I do think that expense and how much you're paying in fees is a very, very important part of a retirement plan. Because if you're paying 1% more in fees, you're going to have half as much money later in retirement. That's a little bit of a generalization, but fees are a huge, huge important part of whether you're going to make it or not. If you're paying 3% a year in fees, which some people are, it's very hard to make money and offset income that you're taking out. Because if you're paying 3% fees and you're withdrawing, let's say 5%, now you got to make 8% just to get even. And your risk tolerance may or may not even allow that. And so we don't want to begin with the setup that's going to fail. And so keeping the fees low, keeping the withdrawals reasonable, those are two really important parts of making sure that you don't run out of money.
We've talked about the stock and bond portfolio, the old 60-40 stock bond split. Let's start with the bonds. Are they in favor right now?
So that would definitely depend on who you ask. Personally, I would answer yes. I think bonds look better now than they have for a long time. There's a little bit of concern out there about the bond market, though. If we keep the tariffs on and we have these trade wars and things, that people will stop buying our treasuries. And so there's a little risk out there like that. But I think it's more likely that we're going to see interest rates fall significantly. And if that happens, your bonds are going to be paying more if you bought them today. And so you're going to get appreciation of those bonds as you hold them. And so we may be getting 4 or 5% income and have 8 or 10% appreciation as time looks forward, depending on the bond, depending on how long the bond is, interest rate sensitivity, all that kind of thing. But generally speaking, bonds look a lot better today than they did, let's say, 3 years ago.
We're talking about successful retirement portfolio and the assets that may be in that with Jake Floyd, Floyd Financial Group. Again, our telephone number 417-889-7233. Let's talk about growth-oriented assets and in particular stocks. Jake, are stocks always an integral part of a successful retirement plan, do you think?
So always is a strong word, but I would say that 90% of the time we're going to have money in the market. If you have saved a significant amount more money than you need, or if you had a huge inheritance or something like that, maybe you don't need any risk at all to accomplish your goals. But for the most part, if you have saved your money in a 401k or something, and you need to get income out of there, you have three basic needs, right? You need growth to be able to offset the money you're taking out. You need some degree of safety. How much is appropriate depends on a lot of factors, but you need at least some safety. And then you need liquidity, right? The problem is there's no one investment that gives you all three of those things. So generally speaking, it's going to be appropriate to have some growth-oriented stocks and things like that in your portfolio, but it's certainly not the only thing we're going to have in your portfolio. As you said earlier, annuities, specifically fixed indexed annuities in today's world, are very attractive because of where interest rates are, where we can get the lion's share of the gain and none of the loss in certain circumstances. Those can really help bolster your retirement and really keep you from losing a lot of money in a lot of those products when we have times like we have recently where the market's real volatile. Can help you not be worried to death and have the white knuckle roller coaster ride that can be the stock market sometimes.
Jake, I would imagine that a big part of a successful retirement plan is dealing with taxes. Tax diversification, how do we accomplish that?
A dollar not paid in taxes is a dollar earned.
Right.
I know that's not quite how the saying goes, but there's a lot of truth to that. And if we can simply pay less in taxes, that's a win. There's also other types of taxes, such as if you retire before 65 and you're on the exchange on Obamacare, if you make too much money, your health insurance costs more, right? Or you get penalized if you make too much money. So there's a lot of taxes that are not taxes that still come from the government. Ultimately, it's kind of like a tax. But basically, all those things, if we can minimize how much the government gets into your pocketbook, then that's just that much less money that we need to pull out of your retirement savings. So all things equal, you just simply have more money, more room to increase income later on, and that sort of thing. We definitely have a big eye toward trying not to pay Uncle Sam any money that he's not due. Again, if we make money, we're going to pay taxes at some point, but at the same time, we don't have to necessarily take it all out in 1 year and get killed on taxes. We can keep an eye on health insurance cost and that kind of thing and try to make good decisions there too.
And the tax code, I think, is written in pencil because they seem to erase it and then rewrite it every year. So it's so important to stay on top of tax diversification strategies. And that is something that we pay a lot of attention to here at Floyd Financial Group with things like Roth IRAs and that sort of thing. Let's continue to talk about the successful tools in a retirement portfolio. I think a big one's going to be the withdrawal strategy, Jake. How do we handle withdrawals?
Yeah, so again, I hate to preface this every time with it depends, but it does depend on what kind of savings you have, whether we have mainly 401k savings or if we have after-tax savings, Roth savings, that kind of thing. But yeah, basically one of people's biggest questions when they get ready to retire is how do I turn this pile of money into income? And how do I make sure it's going to last? And so we talked about safety a little bit a few minutes ago, setting up a bank link to your account and prepaying the taxes and then sending you basically a paycheck, right? So if you need to get $1,000 a month or whatever to supplement Social Security out of your investments, or maybe it's $5,000 a month, depending on the size of your savings and that kind of thing. What we do is we set up a link generally to your bank account, and then we direct deposit that money once a month. We can do it more often if you want, but I don't like to have to pay bills any more than I have to, so usually we do once a month. It just goes in there like you're getting a paycheck. And so it's dependable, and it's not going to not show up one of these months, that kind of thing. And so as we're creating the plan, when that money hits, how much goes in, how much we hold up for taxes, those are all considerations that go into play. Holding out money for taxes while you're not holding money out of your Social Security can be a little bit of an art form, and so can require a little bit of walking in. So it's not going to be perfect where you get zero refund and you owe zero. But yeah, those are things that we have quite a bit of experience with, and we can usually get pretty close on that.
And we talked about the 4% rule, which is more of a suggestion than anything else. That doesn't work for everybody, withdrawing 4% of your retirement portfolio. Jake, is it possible to never touch the principal in your withdrawal strategy?
It is possible. For most people, because we're going to have some money at risk, you're going to have some fluctuation. So to say you'll never dip into principal is a big statement, but over time, the goal would be to have the account grow as we're taking money out so that later we can increase your income, because heaven knows it's going to take more money to live 20 years from now than it does right now. And so we need to leave some room in there. And if the account balance is going down, obviously we can't really increase income too much. So the goal is going to be to take a reasonable amount of income and try to make more money than that so that we have the balance going up in retirement, and then we'll take in more income later to offset inflation.
And again, a successful retirement portfolio does include a plan for long-term care and healthcare expenses. We talked about that a little bit in the past segment, and of course, estate planning too. So I think having a successful retirement portfolio involves having a diversified income plan, maybe some bonds in there, growth-oriented assets such as stocks, tax diversification, withdrawal strategy, of course, healthcare, long-term care, and an estate plan. If you're unsure whether or not you have a successful retirement portfolio, you'd like to talk to us here at Floyd Financial Group about that, we'd be happy to take a look at where you are in your retirement journey and help you make any changes to your retirement plan if necessary. Again, our telephone number, 417-889-7233. No cost, no obligation, no judgment to take a look at your retirement portfolio. We'll meet you where you are. 417-889-7233. You can also find out more about us online at floydfinancialgroup.com. Time for a break, Jake. When we come back here on Show Me the Money, we'll be talking about the differences between an independent advisor such as Floyd Financial Group and the big box stores when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
People of the Ozarks, step away from the fishing pole and prepare to be shown the money, because we're back with more straight talk and honest answers with Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. In this last segment, we're going to talk about how smaller advisors differ from bigger advisors.
Right, and the advantages of an independent advisor such as Floyd Financial Group versus some of the big box advisors. We love the people that work over there, but I think in some respect they have some handcuffs on them. So let's talk about it. Let's break it down a little bit and see whether or not our listeners would be more suited with an independent advisor or with some of the big box advisors. First thing comes to mind, Jake, and I think it's very important, is the fiduciary responsibility. A little bit different with both of those concerns.
Yeah, when I say smaller advisor, we are a pretty large advisor in this area, but relatively speaking to Morgan Stanley or Merrill Lynch or somebody that has billions and billions and billions under management, we're relatively smaller than they are. But yeah, I think a better way to look at it, like you said, Jeff, is independent advisors versus big box advisors. There's two kind of main things. Actually, I'd say three main things. So number one, you talked about the fiduciary duty. So most of those other advisors would also say that they have a fiduciary duty to the client. Problem is how fiduciary, by the way, let's just define that for a minute, means that you have a legal obligation to put the client's interest before your interest as the advisor. So me having a fiduciary obligation to my clients means I put them first, no matter what that means. And I think that the problem with that is if all I can offer is the stock market, or if all I can offer is CDs, or if all I can offer is annuities, how can I possibly be a fiduciary? If I don't have the tools necessary for my clients in any environment, how can I possibly fulfill that fiduciary obligation? And in my opinion, I don't think you can. And so that's why I feel like I have to have all the tools available. You know, we need to be able to use stocks and bonds. We need to be able to use annuities. We need to be able to use gold and investments tied to the value of gold. We need to be able to invest in real estate. We need to be able to do all those things so that I can fulfill that duty, which is a duty I take very seriously. And I always put my clients before myself. And that's a fundamental thing that we've been doing here since before it became a fad to do so. But the investing world for a long time was not that way, where you had suitability standard, which means that it just has to be suitable. Whether or not it's the best thing for you is irrelevant. And so I think by and large, investing is slowly but surely getting better for the customer, but it is still a buyer beware market out there, and not everybody does put you first. My goal is just to try to take care of my clients. I think if I take care of my clients, that I'll get taken care of, and that's so far been abundantly true. If I take care of you guys, God will take care of me, and that's how I look at it. And so when it comes to fiduciary duty, I think that's one of the really big areas. Another big area is fees and cost. A lot of the big box guys, they have so much overhead that they have to charge a lot more money to manage money. A lot of times the guy that you're talking to, the the advisor, is not the person actually making the financial decisions. In fact, I would say 90% of the time they are not. If you go over there, you talk to the advisor and they say, hey, great, I'll charge you X% to manage the money. Then they turn around and put you in a bunch of mutual funds. If you're in a bunch of mutual funds, chances are you're in actively managed mutual funds, which means that those mutual funds are the ones actually managing your retirement portfolio. And so if the mutual funds are managing the money, then why are we paying the advisor to not manage your money? I don't think you should. That's a fundamental difference. At Floyd Financial Group, we make all the investment decisions right here in-house. There's no third party that's managing your money. And that really allows us to keep the costs down way below where a lot of these other guys operate, which I personally think is part of my fiduciary obligation, is to keep fees as low as I can. I mean, obviously I have to keep the doors open and the lights on, but other than that, I need to keep fees at a very reasonable rate so that it's better for you over the long haul.
Yeah, and a lot of people don't know that during breaks, we often talk about what the market has done this past week. And yeah, there at Floyd Financial Group, you and I talk during the week, and so many times you'll say, hey, wait a minute, look at what the market's doing, or look at what Bitcoin or gold is doing too. You've always got your eye on what's happening out there in the markets to the benefit of your clients. So again, fiduciary responsibility, very important at Floyd Financial Group. We're legal fiduciaries. We're also moral fiduciaries. And at many of the big box advisory firms, they're simply held to a suitability standard, meaning that they can recommend products that are merely suitable, even if they're not the best for you. Also, there's no proprietary product push. Independent firms, they're not pressured to sell their own company's mutual funds, insurance, or annuities. But the big box firms, Jake, are they given suggestions or maybe edicts that, listen, this is what the company needs to sell today? And the advisors are really more like salespeople than they are really true fiduciary advisors.
I would agree with that, Jeff. And I think not all of those firms work that way, but there are a lot of these firms that get kickbacks based on how much they invest in certain mutual funds. I don't want to name names, but there are firms out there that if I know you're with that firm, I can tell you what you own without you even showing me, because everybody owns the same thing. The company makes a whole lot of money doing that. I don't think there should be any party involved other than you and your advisor when you're deciding what is best for the client. There should not be anybody else with their finger in the pie trying to take a percentage, right? If I've learned anything over the last 18 years of being here, it's that how many people get paid before you get paid out of your investment is one of the keys to success. Minimizing the amount of people living off of you, how many parasites you have in your investments, is a really big deal. So like picking on REITs for a second, right? So real estate investment trusts look really good on paper. You have 10 or 12% gross investment returns. But the problem is in those investments, you got to pay the guy who put the investment together. You got to pay the agent. You got to pay the real estate guy that's helping you make the real estate transaction. You got to pay the lawyers. Then once you have the property, you got to pay the property manager. You got to pay the people collecting the rent. And then finally, you start to get paid, right? Mm-hmm. And so minimizing the layers of people getting paid out of your money, I think, is one of the big keys to success in investing.
Right, and big firms sometimes do layer in those hidden fees or commissions on products. We're not saying that all of them do, but many of them do. It's just part of their business model.
Yeah.
Talking with Jake Floyd of Floyd Financial Group, and we're talking about an independent advisor versus some of the big box stores out there. You all know who they are. Customized holistic planning. When I think of the big box stores, Jake, I think of stocks and bond portfolios, but I don't think of more extensive planning such as taxes and Social Security timing, estate. Am I wrong or right about that one?
Well, in fact, a lot of those firms will refuse to give you any kind of advice that has anything to do with taxes. They'll say, we don't give tax advice. Talk to your tax advisor. Well, it's impossible to deal with investments, in my opinion, without having an eye toward taxes. Now, that does not make me a CPA, but taxes are an integral part of any plan. And if they're going to just turn a blind eye to taxes, that is not in your best interest. And again, I think it's important that we state again, this is not all firms, but many of those firms do fall into that category. There are some firms that do better than others and that are more willing to help people than others. I do think that they're not all created equal. And ultimately, in retirement, what you want is a firm who is going to be there to hold your hand through tariffs, for example, right? Or whatever the moment produces and whatever questions come up, be able to answer those questions to a way that satisfies you and gives you some certainty in your life looking forward, instead of you sitting at home wringing your hands wondering what's going to happen with taxes or tariffs or the market or whatever. I'm sure it's much easier to just say, hey, I don't give tax advice. But ultimately, taxes, and to extent some of the legal things that we've talked about with estate planning, again, I don't practice law without a license, but there are some things within my purview that I can point to that'll help you on your journey in retirement.
And we do have an estate planning attorney in-house in Elizabeth Floyd as well, too. So we can talk about that, but we can also talk about tax planning, Social Security timing, estate planning coordination, long-term care strategies, retirement income design, and so much more here at Floyd Financial Group. I think another advantage, and you touched on this a little bit, Jake, is the fact that when you call us here at 417-889-7233, you're going to be able to speak to the person actually making the decision. They'll many times often speak with you, if not all the time, Jake, right?
Absolutely, Jeff. Probably the best thing I could do for my business is hire a whole bunch of other advisors, but I don't want the headache of having to deal with that. And I don't trust other advisors to take care of people and care about people the way that I care about them. And so I've kind of hit the limit of how big I want to get. I don't really want to get a whole lot bigger by client size and that kind of thing. And so we do take on people that are a good fit, because obviously as time goes forward, I have clients that pass away or move away or whatever, but we're not in expansion mode really right now. What I want to do is try to help protect and grow the client's money that I've been entrusted with. And then where it makes sense, if those people have referrals or people that come in that are a good fit, and we have good conversation, then that's good too. So we're not just saying, hey, come one, come all at this point, but I do want to help anybody out there that needs help. So if you guys can give us a call and we can do a free consultation if you'd like.
So at Floyd Financial Group, you have the opportunity to speak with the founder when Randy is in the office, but also you as the president of the company too. You're not passed around to a junior executive or someone like that. I want to finish on this note, Jake, is that at Floyd Financial Group, it appears to me that what we're trying to do here is develop long-term relationships. You're not just another number in the hopper of numbers.
Right. And we have clients we've had over 20 years now. And I think it's important when we set up a plan, I plan to execute that plan for as long as I'm here, which is going to be for quite a while now. People who are listening may or may not know that I turned 40 this last year. So I've been here 18 years. I have 18 years of experience in the industry, but I'm only 40. So I'm going to have time to be here versus a lot of other advisors are 60 or 65 years old and they're kind of looking for the exit. So as you retire, you don't want your financial guy necessarily to be retiring along with you, right? And then you're kind of stuck with somebody you don't know. So I think that's important. And looking forward, I intend to make good on the promises that I've made to my clients over the years. And that's a very important part of why I do what I do.
So, Jake, I think the summary of our conversation here is that if you're someone who values custom advice, transparency, maybe a deeper advisor relationship, going with an independent firm such as Floyd Financial Group, it really can be a smarter long-term move, especially when preparing for retirement. So if you'd like to get in and sit down with us and let us show you the difference between us and some of the big box advisors, we invite you to call us right now at 417-889-7233, 417-889-7233. That's the number to call to request your Floyd Financial Group financial review. No cost, no obligation, no judgment. We'll meet you where you are. 417-889-7233. We also invite you to go out to the website, floydfinancialgroup.com, and check us out there. Well, Jake, we're out of time for this week. I want to thank you for your time, but most importantly, I want to thank our great listeners for joining us here in the greater Springfield area, the last bastion of sanity. So for Jake Floyd, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here with another edition of Show Me the Money on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning is offered through Floyd Financial Group, LLC, an SEC registered investment advisor.